Welcome back to Going Solo. Today I'm joined by Adam Besvinick of Looking Glass Capital. Thank you for joining me, Adam.
Thanks for having me, Dan.
What did your journey look like getting into VC? Like, at what point did you wake up and think, like, I want to be a VC? This is the path for me.
I went back to business school in the fall of 2011. I was fortunate enough to be in New York working as an investment banking analyst at a time when New York was seeing a resurgence kind of post-financial crisis. So this was like '09 to 2011. And New York tech was kind of on the rise again, I would say then. You had companies like, Foursquare, Tumblr. New York Tech Meetup was actually a real thing with real, companies presenting. I remember going and seeing Travis Kalanick announce that New York was going to be the second city that Uber was launching in, and I kind of fell in love with tech as a user first. And so in my limited time, I was going to tech meetups and trying to get to know investors and sending cold emails. And I was doing this all while I was an analyst at Jefferies, and then knew that I was going back to business school in the fall of 2011. And so I basically asked people, how should I spend my 2 years of business school if I want to be in a venture seat when I graduate? Not really knowing, frankly, now 15 years later, like what that really like entailed and meant. But had gotten coffee with and done calls with like tons of different investors, and off of these cold emails. And one of the people that actually responded to me was Chris Sacca, who had started Lowercase Capital. And Chris answered a bunch of questions for me over email. And then I would send him companies I thought were interesting, or I would tweet at him, or, when he was still active on, extremely active on Twitter back then. And I eventually started working remotely for Chris in the fall of 2011, about like 2 months into starting at business school, and effectively like worked remotely for Chris like 10 to 15 hours a week as a part-time associate when it was just him, helping with portfolio companies and diligence and research and sourcing stuff and going to demo days and sort of doing all of the things that like a young associate would 15 years ago. And that was sort of my foray into like trying to understand what working in venture actually was.
Of all the firms you could start with, like, that's maybe the most legendary. Is there something like a lesson you took away from Chris or the time there?
I think a couple things. One was always like add value before asking for value. And so like that was sort of how I think in some ways like convinced Chris to like let me even like work for him a little bit. Was like I was sending him like blog posts I wrote or companies I thought were interesting. Was like doing the job before having the job. But also that's now how I think about like investing in companies and working with companies, and like, hey, I can make a bunch of intros for this founder, connect them with other founders in the portfolio, doing stuff, basically understanding this is what I'll be like on your cap table before I actually am, and demonstrating sort of what it would be like to have Adam and Looking Glass as an investor before, I actually wire money. And then the other piece is related to this, which is just like, I would say like extreme deference for entrepreneurs, right? Like the job of being a founder and an entrepreneur is, much harder than being a VC. Definitely way harder than being a VC at like a large platform fund. And even harder than being a VC, in my opinion, as a solo GP, small fund. Though maybe the gap is not quite as wide. And so I think having that level of respect and deference to founders, and sort of the view that having an amazing reputation is what allows you to see better opportunities, allows you to win allocations in competitive rounds, like that reputational currency compounds over time. Like that's one of the other things that I like took away from working with Chris. And that's really been like sort of a North Star focal point for me since getting into venture full time like a dozen years ago.
I do wonder if there's something about the similarity of being like a solo GP, particularly like a new solo GP, where your existence is a lot leaner. You know, your fee income isn't great. Fundraising's a headache. Something about that makes that category of investor empathize more with founders. Like maybe he's more aligned with them as well. Maybe that helps somehow.
It definitely is more aligned, and I've found that I don't know that it necessarily wins you allocations in rounds or wins, leading rounds, but I do think that, sort of my success is founder's success and vice versa. And I've noticed this with a bunch of companies. I'm now beginning to invest out of a third fund, but I've seen this across fund one, fund two, and I'm sure I'll see it even across, companies in fund three. But like there are founders in fund one and two that I like, in some ways I think are like rooting harder for me than I am for myself. I've used them as references with other founders to like, convince companies I want to invest in that they should take my money. I've used them as references with LPs who want to talk to founders that I've worked with. And, they're sort of like my biggest, outside of like my wife and kids, probably like my biggest cheerleaders in many ways. And so I think that there is definitely, they understand that they're building a company, and so am I. It's just a different type of business.
Yeah, for sure, and with its own unique challenges. Speaking of which, like you raised the first fund in like 2019, 2020, and you've raised two funds since then. Like you're kind of in the middle of the fund three at the moment, I think. So you've seen a little bit more of the fundraising market than some of the other emerging managers we speak to. So I'm curious, over that time, how do you think it's changed?
I think that I started fundraising like maybe like half a turn too early for fund one, right? Like I started fundraising January 2020, and fund one ended up being like $8.5 million. I didn't benefit from like the zerpiness of fundraising as much as other emerging managers that were out in like the back half of 20 through 21.
Mm-hmm.
And even though I was still fundraising through 21, I think that like, I don't know, that style of fundraising and that style of that LP that was swayed by that type of investing, it's like never been a fit for me.
Mm-hmm.
And that was just never weren't the types of companies I was investing in, like the flashy, shiny object things. And I think a lot of those LPs who probably back those funds have like disappeared. I think fund one was sort of like a very like standard like slog for me. I don't think it was like dramatically hindered all that much by COVID. I think like net like probably was how it would have been if COVID hadn't happened and if the ZERP craziness of 21 hadn't happened. They like kind of balanced themselves out in my own fundraising. Fund two was by far the hardest of the three. 2023, like I did a first close sort of end of 22, early 23, raised a lot, tried to raise a lot in 23, did most of the fundraising in 24 while I was deploying, sort of like dollars were coming in and dollars were going out. Ended up getting to just under 15 million for fund two. So like a meaningful sort of step up from fund one. But 2023 was by far the hardest fundraising environment I've ever encountered as a manager, and I also just like for companies that were out fundraising during that year. It was also the slowest deployment pacing for me of any year, probably partly due to my own fundraising sort of like challenge at that time, just like not wanting to like overextend myself prematurely. Fund three has been the easiest, knock on wood so far of the three. I think partly it's, survivorship. So like, all right, if you're raising a fund three, like something has had to have gone right to get to this point. Otherwise, you're just delusional.
But is that based on like incremental metrics, like progress
incremental
so far?
metric, right? Like, yeah, if you're credibly going to market trying to raise a third fund, that's like a decent step up from your last one. Like, in some ways, it's like the founder who goes out to raise a Series A or Series B. Like, something has to have gotten right for you to credibly have these conversations, right? Like, something interesting is going on. Is it truly compelling? To be determined. But like, there's definitely something interesting happening here and worth digging into as a VC looking at one of those rounds or as an LP looking at, a fund 3 type of thing. I also think the metrics and traction of fund 1 and fund 2 have borne themselves out around my like style and strategy and approach. And LPs, specifically like larger, more institutional, quasi-institutional allocators who wanted to see that, sort of see that playbook, actually working. It is. And so I think that that's given people a lot more comfort and conviction around what I've been working on, particularly those that I've been talking to for quite a while. There's institutional capital in Fund 3, like endowment capital in Fund 3. And that's a group that I spoke to starting in April of 2024. So they saw Fund 1 start to mature. They saw Fund 2, the back part of Fund 2 get deployed, and the markups that came with that and the progress that came with that, and the alignment with that strategy with Fund 3 and how it sort of set myself up well to do Fund 3 with the strategy. Getting them to come in has also given, there's signal, just like any VC, just like any round with a credible VC lead, like lots of people want to come in with, institutional endowment capital. It's like, okay, this firm, even if it's a single GP, is operating in an institutional way, built for the long haul, running a system and process that is sustainable and scalable. And sort of, if you can get institutional capital, then like you clearly have checked a lot of boxes from a diligence perspective, reference checking perspective, that gives, people are still going to do their work, but it gives them like an additional level of comfort when they talk to you.
How do you deal with the, I would say, like quite rightful skepticism about like early marks? And, if you're a young GP or GP of a young firm, you don't have huge amounts of DPI that you can demonstrate most of the time. TVPI, IRR, these things can be quite dubious. So like, how do you get over that? That seems like a tough challenge.
I point to things that I feel like are going to be the likely outliers in the portfolio and provide underlying metrics and traction as to why I believe that they are. And sometimes that doesn't correlate with marks, frankly.
Mm-hmm.
So like the fastest growing company in Fund 2 raised a pre-seed last June, raised a price seed round before the end of last year. And then they just raised a large uncapped safe. So like the mark is actually not really that high, frankly. I think it's like a little over 3x what I invested at. But the business went from 0 to over a $50 million run rate in 10 and a half months. So like I'm holding it at 3x my entry price, but like it's probably 4x from there, like comfortably. And so trying to provide additional detail around specific companies in the portfolio and why I believe they're outliers, whether it's around traction or the market size that they're going after, or the quality of the entrepreneur and sort of, pedigree and relevant operating experience, and why they're well suited to build an outlier level company. Because I think, to me, like the secret to actually generating like a well-performing fund is you need to have, it's a race to figuring out which company is going to be the fund returning investment in the portfolio. And once you have one of those positions, the bet obviously then is that like, all right, it's going to go beyond 1x hopefully, but also if you can get that type of return out of one company out of, in my fund size, like around 30 companies, it's probably not the only company that's going to have that level of success, right? You'd like to think that you didn't get lucky on that one out of 30 and everything else is going to go to 0. Like you might not get 2 fund returning companies in the portfolio. I think Samil Shah tweeted like a week or so ago that like the average fund returning position in some of these largest names over the last like several vintages has been 1.7, right? So like less than 2 fund returners. Now a fund returner could be like 5x the fund, right? It just has to be at least 1x. So it could be an extreme outlier, but like you're probably not going to get like 5 fund returning positions in a 30 company portfolio. But
unless you're Chris Sacca.
unless you're Chris Stock, exactly. But like the bet though is like, all right, you got one fund returner, and of the other 28, 29 names that you have in the portfolio, there's probably at least a handful of others that are returning, half the fund to 1x the fund, and that gets you to your like 5x fund size.
Do you find it works better with like some categories of LP over others? Like some are more receptive to like, let's say, a more complex qualitative argument about the value of a company, whereas other LPs might just be like, show me the marks, that's all I care about.
In a word, yes. I also think that we've spoken about this. Like my portfolio is, I think, made up a lot of like slow burners, basically. Like within healthcare, sales cycles can be long. Within energy and climate, selling into utilities, sales cycles can be longer. ACVs can be quite high, but like the sales cycle and the path from like 0 to 1 might take a little bit of time. And so, but also I've had like a lot less attrition than most investors. Out of the first 55 investments across the first two funds, there's only been 4 write-offs. Like the other 54 companies are still 54 positions are still active. And so like I've ended up having a lot less. And in fact, one was like returned a third of the money. So like not even a true zero. I've had a lot fewer zeros than I think a firm that's 5.5 to 6 years old would have had investing at pre-seed, sort of first money into businesses. And so I think the LP type that's gotten the most comfort with my strategy and discipline around price and ownership and relative concentration is typically been an LP who doesn't have to remarket themselves to LPs themselves. So like I've had way more success with family offices, individuals, even endowments, despite my smaller fund size, than fund of funds. And I don't, it's not, I have a fund of funds in the fund as an LP. I think a lot of fund of funds that I've spoken to have latched on to like, where's the shiny object? Where are the extreme outliers? You're not a spin out. Like they have to market themselves just like I do, right? Like they have to go out to LPs. They have to sell a story. They have to convince other people to give them money to then give me money, right? I think that's a marketing exercise. And if you aren't flashy and sexy, it's harder to market that. And so I found that like, people that have a larger permanent capital base who don't need to go out and remarket what they have in their portfolio have had there's been a higher degree of resonance with them around the strategy and the composition of my portfolio and the style of investing that I've been practicing for the last half a dozen years, basically, since starting the firm.
A good piece of advice that Arian from Earthling shared, I spoke to him last time, and he was talking about a piece of advice given to him by Adam Draper of Boost, who said, it's paraphrasing roughly, he said it's kind of a waste of time to talk to LPs unless you know that they're interested in venture to begin with, and also that you have a pretty good idea that they're interested in the kind of strategy that you're offering. So how do you go about finding that kind of LP that you think will be well aligned with you?
To me, that's the hardest part of this job, is figuring out who the most likely LPs are to commit. And it's extremely opaque. And this is up and down the LP, variety stack, right? Whether it's a family office or any sort of pension, endowment, et cetera. Like I actually think it would be easier to raise a larger fund where it's a known set of LPs to go to who, that if they're of a certain size, they have a venture allocation. Now the question is, does your strategy align with what they care about, et cetera? But if you're raising a $100 million plus fund, like, you can go to this sort of like finite known set of names of institutional allocators, of which there are, scores and scores of them.
Mm-hmm.
Raising a sub $50 million fund, I think, is way more challenging in that like the known set of LPs, the best set of LPs are probably family offices. And that's an extremely opaque process. To me, the best way to do that is through other managers. That's the most certain way. in terms of getting insight and data and anecdotes around what that process was like, and if they actually are deploying, and check size, etc., and what their process is. But that requires having a lot of conversations that are not actually about raising capital. They're conversations about how to raise capital as opposed to like actually pitches. And it'd be like talking to a founder who's like, yeah, this founder's going to talk to a bunch of other founders. Like that founder just wants to go out and talk to VCs. Like doing the legwork up front to talk to a bunch of other founders about who to talk to and then go and talk to them is like, in some ways feels like a lot of work.
Mm-hmm. In the conversations I've had, particularly with mostly on like the fund of funds side and selecting emerging managers and designing emerging manager programs, of the three things to look at, the other two are kind of like education about the market and differentiation. But the third one is motivation. Like, why does someone want to do it? Do you get a real sense that they're going to still be wanting to do this in a decade plus?
I got that question a lot when I first started. Like, oh, why are you doing it solo? Like, are you doing it solo because you couldn't convince anybody else to do it with you? Like, no, like, like, no. That's not why. Like, if, and then I got a little bit of that question around raising funds too, like, less about motivations, but more just like stamina. And now that I've been doing this, waking up every morning solo, for 6+ years, flipping open this laptop, like, it's like pretty sure I'm not going anywhere, right? Like, it'd be a little weird to throw in the towel. You know what? Like, I'm done now. Like, I've gotten through all like the hardest, got through all of the hardest parts. I got to a third fund. I got institutional capital. Like, you know what? Now I'm gonna now it's time to stop doing this.
I think also probably like looking at people who write a lot, and you certainly were in the camp. I don't think you've written much on your blog in the last few years, but up to 2020, you wrote a lot, like and really interesting, very insightful stuff about venture capital. Like that's probably a pretty big green flag for a GP, I would guess.
I think so. Yeah, I was like relatively, I would say, prolific. Like I did used to write a lot more. That was before kids came around. But yeah, I think it definitely is. I think I try and still put some periodic thoughts and commentary out there. I do write a note to potential LPs every other month, basically. So like I send out LP letters every 8 weeks to Fund 1, Fund 2, and Fund 3 LPs. And there's some sort of market and, sort of venture commentary at the beginning of each of those letters, which is specific to the moment in time in which I'm deploying each of those funds. So like the commentary for Fund 1 LPs is different than Fund 2, which is different than Fund 3. And then I write sort of a note, sort of aggregating some of these thoughts that goes out to, friends and followers of the firm and potential LPs in Looking Glass, which I've done without fail every 8 weeks since I started the firm, since I started writing these notes in the fall of 2020. So I think I've written like 34 or 35 of these. It gives people a pretty good sense for like how I'm viewing things, even if I'm not, putting it on Twitter. Though I did write a post a couple weeks ago on Twitter. The first time I wrote I'll say a blog post in quite a while around my view on pre-seed in contrast to seed and valuation and sort of the Looking Glass strategy in contrast to sort of other small fund strategies. So I think that was probably the first thing I've written in publicly in a while where I was sort of much more explicit about like my views on the category and space.
And you've resisted so far like outsourcing this job to Claude or to some other mechanism?
I mean, I'm a Perplexity subscriber. So I'm getting access to, Claude and, OpenAI, models. And I use it to help sort of, organize thoughts, but I'm not going to use it to, do my job. Right. So like, and I write a note on every single company in the portfolio to LPs, and that is coming directly from founders' mouths or email updates, and then I'm synthesizing that. That stuff does not go through any sort of like AI to organize commentary on it.
Yeah, I'd say that's probably good advice for anyone, good practice generally. Talking a bit about what you invest in, you have been consistent, I believe, since the beginning of investing in three themes: health, climate, and empowerment. Like the first two, I think are like kind of obvious, but correct me if I'm wrong if you have some unique angle. But on the third, on empowerment, what does that mean? What are you looking for there?
Yeah. So like within health and climate, I've largely done pure software tech enabled businesses. I don't do deep tech, frontier tech within those categories. I don't do life sciences or bio within healthcare. Um, Within empowerment, it's been what I would define as, or the way I define it is anything related to education and teaching and learning. So it could be like stereotypical ed tech, but it could be like upskilling, training. Doesn't have to be selling to a school district. In fact, I hope that it's probably not selling to a school district oftentimes. Tools and platforms specifically serving small and medium-sized businesses as their target customer. And that's vertical agnostic, but it has to be SMB as your target sort of entry point. And then products that enable access or self-expression in some way. And so those are the constraints that I put around what empowerment, or what I now describe as like economic drivers, like those are the constraints around it. And I don't deviate from those subcategories. And so for me, like access could be like financial inclusion, financial access. So I was the lead investor in a company called Starlight in Fund 2. They sell to financial institutions, credit unions, community banks, and then now increasingly some other groups, helping their clients and customers figure out what government benefits they qualify for more easily, and then claiming those benefits. And then now moving beyond just government benefits, but other subsidies that like a utility might provide to their users who are below a certain sort of income threshold. And then on the self-expression creativity bucket, that's generally been sort of prosumer tools. There's a company in Fund 1 called Untitled, where I was the first investor, and they're building effectively like a mobile digital audio workstation for musicians and producers, a place to store and edit and collaborate on all of your work in progress content. And I led their pre-seed round and brought in General Catalyst, and then Andreessen led their Series A. And that's an investment that's the fourth investment from Fund 1. It was the least expensive investment I've made across the entire portfolio. And it's the biggest driver of returns across the entire portfolio. One, it's a great example of what I mean by this sort of self-expression bucket and creativity. But two, like to me is sort of like the quintessential like looking glass investment. Two founders, sort of deep product insight and relevant experience around what they were building, and sort of an edge around go-to-market and user acquisition, but first-time entrepreneurs, and belief, at least in my opinion, that like entry price and valuation is not, necessarily indicative of like scale of founder ambition or likelihood of success.
For sure. But do you think there's like, did you feel any particular way about that when you invested? Did you feel like it had some greater chance than other investments? Do you believe that's possible? Or when you make an investment, do you basically say every investment you make has the same odds of success, more or less?
I view every investment having the same odds of success, effectively, more or less. I think if you only invest at a certain stage, I think you're kind of deluding yourself into thinking that this company has like a better chance of succeeding than another. Now, I will say for me, entry valuation, whether it's price or post money cap, what have you, like to me, I use that as a proxy for risk. And so the lower the valuation, to me, the more I need to be compensated for the risk that I'm taking on. So I need to own the same amount for a smaller check, basically. And to me, the inputs for quantifying risk relate to likelihood of success in some way, right? So like effectively, if I'm investing in something at a 10 million post instead of a 5 million post, like I'm kind of telling myself, I think this is half as risky as this other thing. And those inputs for that risk are like founder background and profile, right? Like young first time founder, never done this before, versus maybe repeat founder or just like more seasoned operator, first time founder, but they know the category that they're in. They've been building for a dozen years and now they're finally starting something on their own. The amount of capital raised. Now, amount of capital raised obviously drives valuation a lot at pre-seed because of, basically just backing into a dilution number. But like if you raise more, I generally believe you're giving yourself a little bit more time to figure things out. You're probably going to spend it. I don't think you're going to spend it just as fast as the company that raises $1 million versus $2 million. You're not going to take twice as long, but I also think you're just giving yourself a little bit more cushion to get to that next milestone. So like, yes, there's a little bit higher willingness to pay because you've bought yourself a little bit more time. And then obviously there's some other inputs like, all right, this company is further along. Have you just built more? Do you have customers, users? Are you building in a space in a category that is known for generating much larger outcomes? So I'm, willing to invest a little bit more, willing to invest at a slightly higher price than, something else that isn't known for driving, huge outcomes. Huge being, generational.
Mm-hmm.
Like I need to believe that there's $1 billion EV opportunity with everything I'm investing in. But, there's obviously some categories that tend to outperform or outstrip, others. And so if I'm investing at the higher end of my range, then I'm saying all of these things are like more or less de-risked compared to something at the lower end of my range. And when I see a dislocation between price and risk in terms of what my willingness to pay is versus what I effectively can get a deal done at, then that's either like a green flag or a red flag, depending on which direction that dislocation is going.
Is there anything you would recommend other GPs read about this particular question of like understanding valuation and risk and how you put the two together to build like a sensible investment strategy?
I don't think that it's come from anything I've read or listened to from a podcast perspective. This is just something that I've like kind of crystallized over a dozen years of being in venture full time at this point and seeing like what's worked and what hasn't worked across starting to invest full time at a fund beginning in the summer of 2014 till now. And I've seen, I wouldn't call them, I've called them mini cycles, right? Like there's been certain moments over the last dozen years where things have like, sort of surged like crazy. And then there's been sort of weeks, months, quarters where there's been troughs and people like think the world is ending. And, 2023 was like that. It was like a prolonged window. You had sort of like immediate post-COVID for 3 months. You had sort of 3 weeks around tariffs. Like these are just like all the recent ones that I'm citing where like, people thought you should hunker down, sort of in the post-tariff craziness. So like recognizing like when I've made my best decisions, I've used this framework to help guide what my willingness to pay is and where I've like wanted to exercise discipline around it. I think as a solo GP with no employees, no like literally single member LLC like entity, I've needed to figure out sort of the best ways to have checks and balances on my own decision making without a counterpoint beyond like running something by. I mean, I do run ideas and concepts by founders in the portfolio to get their check on something if they know the category because they're building in it, or LPs who might be operators in a category. But ultimately, like at the end of the day, like I'm the one making the decision. I'm the one that has to get conviction, like internally. And so I've tried to figure out sort of what are the checks and biases I can run on my own and where do I tend to overweight things that shouldn't be overweighted and I can hold myself accountable to them to make sure that I'm not drifting too far afield and getting sort of like swayed by something that I shouldn't be getting swayed by when I don't have another GP to be like, hey, Adam, remember when you invested in this thing 6 years ago and you got super excited about this? Well, that's the same thing here. And like, let's discount it this time. And so this valuation to risk, sort of like balance is a framework that I've like thought a lot about to rationalize like my strategy and to help guide what my willingness to pay is, and where I might not necessarily walk away per se because of price, but like where I get hung up on thing and where I can try and sort of like guide a founder to land at a number that I'm comfortable with.
One of the things I recommend to everyone, but particularly to LPs and GPs, is to read like Daniel Kahneman, like the Hazards of Confidence essay. I think I've linked to in things I've written probably 20, 30 times. It's just a really important concept. There's 4 last questions I'd like to go through quickly. These are questions we ask everyone we speak to. The first is, who's your favorite emerging manager right now? Is there someone else who you think like deserves a shout out or is doing something really cool?
I mean, I think Nico at Adjacent is like a phenomenal investor. I mean, maybe he's investing out of Fund 3. I mean, I don't know what number he's on. He was emerging. I don't know if he's still definitionally emerging or emerged. We have a co-investment in a company out of my second fund that I shared with him. And like, I just think he and the work he's doing over there and adding Paul to that team is like really, really smart. It's a great compliment to his sort of other consumer investing that he's done. So that's one investor that I, whenever I look at something that I think is remotely relevant to what he invests in and likes, like I immediately share it with him because he's somebody that I think love to have on as many cap tables as with me as possible.
And that's just a reflection of the way you think about his judgment in general, basically.
Yeah, his judgment, his work with existing, with this founder, I've seen it firsthand. I'm familiar with some of the other companies that he's backed. I think, his style is a little bit different than mine in the sense that he's not sort of, I would describe him as like multi-stage. I think he's sort of definitely more opportunistic than I am, but I also think he's disciplined in the sense that he cares about like ownership and valuation. Even though he's running a larger, larger fund, larger firm, so he can, play at a later stage than I can more frequently. But at least I think the way that he assembles that portfolio, I think he has, unique taste and perspective, and isn't just going to back stuff because he thinks that there's downstream capital to come along. And to me, that's like where I have the most respect for investors. Is like, yes, you take that into account, but it's not the reason why you say yes to something, and it's not the reason why you say no to something either.
What advice would you give to emerging managers who are basically starting out now, like facing the same kind of challenges that you did, and perhaps thinking more of like your fund 2 and the difficulty, because that's probably more like what they're facing today?
The best advice I got, and it took me a really long time to internalize this, and I kind of implicitly shared some of it, which is like, find the LPs that are like find your people. Like, and it's hard to figure that out, but like when you get a yes from somebody, like do your best to do like a post-mortem on that conversation, figure out like, and maybe even ask them like, why did you say yes to this? What was compelling about me or the strategy or whatever it is that I'm working on that got you over the hump to commit to this, extremely unproven, entity, and use that to help triangulate around what other potential LPs, whether those are individuals or family offices or what have you, like fit that criteria, and work backwards from there. And it took me a long time. Like I had a friend who runs another fund tell me this, and I was like, well, that was, I didn't think all LPs were the same, but I also wasn't thinking of them as snowflake-like as they probably are in terms of their own motivations for why they decide to invest in a fund. And then the other piece related to this is go back to that person who said yes, or that group that said yes, and figure out who are 2 or 3 other people that they can strongly, incredibly make an introduction to on your behalf. And if and they should be able to, right? Like they should be able to think of 1, 2, 3 other people. Don't ask for 10, but make the ask simple and easy. And I think that also has been valuable for me, because in all likelihood, like the most likely people to invest in your first fund are going to be people that or are 1 degree of separation away from you. It is highly unlikely obviously if you're like a huge spin out and raising a ton of money, whatever, like, if you're chemistry or conviction or whatever, this advice doesn't hold. But like if you were, hey, I'm raising a $10 million fund one, like it's going to be people that have gotten to know you over your career, who trust your judgment, who just implicitly believe in you and your ability to execute. And those are the people that you should be going to. And those are most likely the people to say yes.
Yeah, there was an interesting survey. We shared the results of it in an article we published recently, and it looked at the various factors that make an LP more or less likely to invest in any GP, but particularly emerging GPs as well. I think it found that by far the biggest factor was if you have invested with them before, so perhaps they were at a previous fund that you were also an LP in. That was like 7 or 8 times more likely. The next one down from that is that you had a personal relationship with them, and that was like 1.8 times more likely. And I guess that's just because there's so much uncertainty. Any kind of existing relationship is going to make them feel they can make a more confident decision.
Yes, and I also found that my fund one was like heavily populated by like friends like that I went to like college with and business school with, who had made a little bit of money and were like, all right, and I effectively just said like, it's a friends and family discount. like there's no minimum, or like the minimum is extremely low for this group. And this was sort of like peak COVID when I was sort of, I just needed momentum, right? I just needed to it's like the analogy of like a basketball player who's not making any shots. They need to like, if they make a couple free throws, they see the ball go through the hoop, psychologically it opens things up for them. Like I just needed to get yeses, and like getting a bunch of 25, 50K yeses like in quick succession, which almost didn't even require a phone call, was like just an email. Like that just from a morale perspective just helped so much. And some of those, my smallest LP in fund one sourced untitled. Like the biggest position in fund one came from the smallest LP. So like you just never know where value is going to come from. And if you have a bunch of individual nodes in that network, then like it's helpful to you.
Interesting. And I think that's definitely another place, like going back to what we were saying before about emerging managers being able to empathize with founders. Like I can see that parallel with the founder's journey, like pretty vividly, getting the first believers and what it would do.
It's why I've told every individual LP who's been in fund one, like there's a spot for you in every fund as long as you like want to keep investing. Like doesn't matter what, as long as you invest the amount you invested in fund one, at least, like doesn't matter if it's below my minimum, like there's a spot for you. Like I'm extremely grateful for people who help like put me in business.
10 years ahead, if everything works out how you think it's going to, if your thesis is correct, if the world goes in the direction you think it might, what does that world look like?
Probably raising like fund 6, and it's a $50 to $55 million pre-seed fund doing effectively the exact same thing I'm doing now, but maybe like slightly larger checks. Right? Like that's, to me, like the steady state of Looking Glass.
Inflation-adjusted checks.
Yeah, the steady state of Looking Glass is like a $50 million, $55 million pre-seed fund, making 30 investments between like $500,000 and $1 million and change, getting around like 10% ownership with limited reserve. Like that's the steady state. Like I never want to have a fund that's so large that I can't invest in pre-seed as the entry point. And I think once you get above 50, 55, that starts to break.
Gotcha. Makes sense. All right, last question, simple one. If someone wants to find out more about you or your firm, where should they go?
You can check me out on Twitter. It's at Besvinick, I guess X, but I refuse to call it that. BESVINICK, or lookingglass.vc. And I'm just Adam at lookingglass.vc.
All right, Adam, it's been a real pleasure. Thank you for joining, and maybe we'll do this again sometime.
Awesome. Thanks, Dan. Appreciate it.